Is the party over for Mag 7? Or does it just feel that way? Every time the market starts to price in a Fed rate cutting cycle, we see massive asset class shifts, and not just stocks. We see capital fly into fixed income, commodities, gold, and other equity asset classes like small and mid caps that for the last couple of years have taken a backseat to large cap secular growth. And to be fair, so far this quarter, we are seeing the S&P 500 equal weight and small caps overtake the S&P 500. We've had a couple of head fakes over the last year, but it appears the Fed will actually pull the trigger in September. In fact, Jay all but guaranteed it during his Jackson Hole speech when he said, "It's time." So is this it? The signal we've been waiting for? The holy grail data point pushing us into a trade that has only worked twice in the last decade? Let's find out. Welcome to the Money Runner. I'm David Nelson. We can debate how large and how many cuts. But what isn't up for debate is that the easing cycle is about to start. Barring some outlier data point between now and the next meeting, some kind of cut is a lock. Many investors think the stars are aligned for small caps, especially small cap value, believing Fed cuts will drive capital out of large caps into these beaten down shares. They point to 2001, shortly after the dot-com bust. It was the beginning of a 7-year outperformance cycle of small caps over almost all other stocks. Will Fed cuts be enough to pull that off? I don't think so. Back in 2001, Greenspan went on a cutting cycle, bringing Fed funds down from 6.5% to just 1%. That's not going to happen. It may not happen again in our lifetimes. The secular growth themes that will drive our economy over the next number of years are too powerful. Not to mention that government spending is off the charts, beating the inflation beast. What we are looking at is a reversion to the mean. Yes, small caps and other asset classes will play some catch up, but I don't believe they will become the prevailing trend over the next few years. I think the Fed is going to have to live with inflation a little higher than they would like, and employment a little softer. If you're going to buy into small caps, you better do your homework. A lot of zombie companies. You have to look to small cap value to find companies with competitive valuations. And if you're using funds, go active. It might be tough for portfolio managers to beat the S&P 500, but those who specialize in small caps, they have a real advantage. Smaller companies aren't widely followed by Wall Street, and a good small cap manager can add some real stock picking alpha. By definition, small and mid cap stocks will get some help from the Fed. But on its own, it may not be enough. Mega caps like Apple and Microsoft have no need for credit or banks. They have fortress-like balance sheets and can self-fund their working capital. Not so for everyone else. Easing of credit helps, yes. But how much? Right now, rate projections bring the Fed funds rate down to about 3% by the end of next year. The bigger issue is that we may need it. History is not on the Fed's side. In the last half century, every time the Fed initiates a cutting cycle, a recession follows. The only time that didn't happen was 1984. Fed funds might get to 3%, but remember, a lot of credit, including mortgages, are set by the 10-year. With debt and deficits continuing to rise, U.S. Treasury investors, especially those outside our border, will want some food on their plate. Expect them to demand higher yields from governments that can't control their spending. Well, that's it for this week. If you like today's pod, please hit subscribe. And don't forget to visit my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is The Money Runner.